Hello, I'm Calvin from CRC Accountancy.
And hi, I'm Lauren from D&H, and welcome to the third and final episode of our property letting series.
That's right, we're nearly at the end of this series, we're nearly at the end of this year, and we're going to consider what happens when you get to the end of your property letting venture. A wee caveat for today's video, we have filmed this prior to the Scottish Budget on Wednesday the 11th, so any changes that might have happened since then will be featured on our website rather than in this video.
Yeah, so in the previous two episodes, we have traced the start and middle, and now we're looking at the end of your property letting business. So the point that we really want to get across is we can't emphasise enough that you should be prepared for sale and front load the process as much as you can.
Definitely.
The types of things we're thinking about from a legal point of view are, for instance, if there is currently a tenant in the property and you're looking to sell without the tenant in place, then we will need some time to remove that tenant, whether their tenancy is based on an old short assured tenancy or a newer Scottish private residential tenancy. There's a process to be gone through. We need to serve notice on the tenant to remove them, and if there are any issues in removing the tenant, that could hold things up. So just be prepared. And other things like making sure you know where your title deeds are, because if they're held with a bank, it can take a couple of weeks to get title deeds from a bank sometimes. And also make sure that you have all of your paperwork for any planning permissions or building warrants in place for when the sale takes place.
Yeah, no, that's right. So, and from tax, it's kind of a similar thought process. We want to make sure that we know where you're going to stand in advance rather than trying to come up with a solution after the transaction has happened. So there's with any sale, with any kind of big transaction like a property transaction, there's various tax planning angles that we can take. But as Lauren says, think ahead. Talk to your solicitor, talk to your accountant, and make sure you know exactly what's going to happen before it happens.
Sometimes you need to talk to each other.
Yes, we need to talk to each other. And that's what we want to get across through this series as well, is that if we can all get around a table with you, it helps, it speeds up the process for you as a client, and it makes sure that both your solicitor and your accountant are much clearer about what needs to happen, so we can just come up with a plan together and make it all happen for you. From my point of view, for tax planning, there's a few things that you might want to bear in mind. If you are married and you own a property in your own name only, it might be worth bringing in your spouse onto the ownership of the property prior to the sale. There are some tax advantages to that. For example, it can give you access to an extra capital gains annual exemption, which is currently 11,700 of gains that you can get tax-free. So if you're able to double that, then that's a great thing. Next year that's going up to 12,000, so you could have £24,000 of gains in total between the two of you. No taxes payable. If the property has ever been your own house, your main residence, there are other exemptions and rules that we need to bring in there, and we can calculate and see what exemptions you might have for the period that you lived in it, and then also some other exemptions you might have in relation to the period that you let it. Those rules are currently changing. Philip Hammond announced some not so wonderful changes to them recently, but again, it's still worth considering and seeing if there's anything that you can tap into that way. If you are selling something that has been a business property and it's connected to you exiting a business, or it's actually a furnished holiday let, you might be able to get entrepreneur's relief on the sale of that building. Now, what that means is that instead of paying the normal residential property tax rates of 18% and 28% capital gains tax, you only pay 10% tax on the whole gain. So again, potentially a massive saving, but you want to make sure that you've got all the conditions in place prior to the sale, because there's nothing that can be done to get that back retrospectively once the sale's happened.
I think the other thing from the legal point of view, and probably your point of view as well, is just to bear in mind the time scales, because what accountants do, they might want to do certain things in one tax year, carry another piece of work into the next tax year, but in terms of the legal work involved for actually transferring a property, try to let us know as far in advance of the end of the tax year as you can, because it does take a bit of work to transfer a title, particularly if it's an older style of title deed.
Yeah.
So yeah, we do need quite a bit of notice if you do want it done before the end of the tax year. So that's another thing to bear in mind.
Definitely. So another thing that might bring your property venture to an end is not necessarily the sale of a property, but actually death itself. And it's something that's worth planning for, because if you don't have the right things in place prior to you dying, it can make a right old mess for your solicitor and your accountant.
Yes.
So,
Yes, and for yourself,
and
or
for
your well, not
yourself,
yourself,
your
your family.
Yeah.
So some people, when they're thinking about planning for their ultimate death, one thing they might think about is whether they actually want to do a lifetime transfer to usually a family member. So that is something that you would need to speak with your accountant about from a tax plan point of view. And also you would need our involvement, because we would need to be involved in drawing up the deeds to transfer the property. So one thing I just like to make clients aware of is that actually in transferring a property during your lifetime, the work involved in that is actually quite often not that much less than the work involved in actually selling a property. Because we still need to go through the examination of title, and you might need to get new plans drawn up for the property, which all does take a bit of time and obviously will cause a bit of expense for you. So we can obviously make you aware of the potential costs,
Yes.
which you might.
And I think it's worth knowing those costs at the time that you're planning to do any of these things, because any ultimate saving might not be outweighed by those costs. But if there's a chance that you can save a lot more, you and your family can save a lot more money longer term by putting into place these plans, then it's good to know where you stand so that you can enact them in your lifetime if you wish.
So you can do a lifetime transfer. The other possibility is that the property is transferred after your death. So what we would always advise clients to do is to make sure that you have a will in place. If you don't, then the law will tell you, or your family, what is to happen with that property once you die, and it might not necessarily be that the property goes to the person that you want it to go to. So always make sure that you have a will in place to deal with who you want the property to transfer to.
And make sure you keep your wills up to date. If there's any material change in your circumstances, you definitely want to get back in touch with your solicitor and make sure your will is up to date, because like Lauren says, you want the stuff that you've worked hard to earn to go to the people you want it to go to.
Yeah, exactly.
Another wee point on the kind of the death estate for inheritance tax, and we've touched on them before, is furnished holiday lets. Now, we do like these, we've mentioned them a few times in this series, our old friends. So the good thing about them is the furnished holiday lets can potentially qualify for a relief known as business property relief. What that means is that up to 100% of the value of that property can come out of your estate for inheritance tax purposes, so you might not have to pay inheritance tax on its value. Now, the qualifying conditions are of a higher level than they are for getting entrepreneurs relief and getting the income tax advantages. But if you're in that position and you have significant assets and you think inheritance tax is going to be an issue, then we can work together to make sure that you do qualify for business property relief on those properties, and we can explain exactly what's required in order to achieve that.
So I think the point that we're trying to get across generally is be as prepared as you can be for all of these possible routes that you might want to take to bring your business to an end, or might have to take to bring your business to an end. So I think that concludes the final episode of the series.
Yeah, I know. It's an end of an era.
Yes. We will be back.
We will be back, exactly, yes. No.
You might be pleased to know, or perhaps not.
Who knows? But no, hopefully you've taken away something from this series. Maybe it's kind of sparked something in your head that you've realised actually might apply to you. If it does, and you haven't already done so, feel free to get in touch. We'll both be more than happy to help.
Definitely, yeah.
And like we say, if it's something that can make your life a bit easier and we can all get around the table together and thrash out a plan, that's what we want. We want you guys. We want to make it as easy as possible for you guys. So yeah, hopefully you've enjoyed it, and until next time, we'll see you again. Cheerio.
Bye.